Yo, welcome back to the channel, man. Episode 2. If you're new to the channel, hit that subscribe button, hit that notification bell. We get into it, man. This is episode 2 of the Path to Profitability series, where we're becoming profitable traders day by day, taking it a step at a time, brick by brick. Episode 1 recap. We talked about candlesticks, knowing what candlesticks mean, just going over the basics of candlesticks pretty much. Um, we learned about the highs and lows, how to identify highs and lows in the market, um, how to identify higher highs and higher lows so that we can identify trends in the market. And so now on episode 2, we're going to be talking about liquidity. Liquidity helps us predict where the market will go based on where resting orders lie for the major buyers and major sellers in the markets, which we're gonna get all into that in this video, man. So without further ado, let's get into it.
First and foremost, what is liquidity? Okay. What is liquidity? Liquidity is resting orders. Okay. That's all it is. Okay. It's just resting orders on the chart. Now, why is this important? Okay. So the first thing that you guys are going to write down, all the beginners. Okay. What? Jeez, we're glitching. What liquidity? What is liquidity? What liquidity? Where liquidity? What is liquidity? Resting orders. Okay, and all of you advanced people, you guys are probably gonna be like, I already know this. Shut up! Shut up! Shut up! Shut up and trade, bitch. Okay, shut your mouth. You guys are going to learn something from this. Okay, what's liquidity? It's resting orders. Okay, now why is liquidity important to us? Okay, why do we want to know where resting orders are? Well, in order for the market to move, it needs what? Orders to be filled in order to push the market, in order to be able to push the market in the direction that it wants to go. Because if there's no orders getting filled, then the market's just going to go sideways, okay, and not move at all. Okay, orders are constantly getting filled while the market's open. Okay, so why do we want to know where liquidity is? Because there's resting orders and at areas of liquidity. I was about to jump forward and give you guys a sneak peek or tell you guys the secret of where liquidity is, but we're not quite there yet. We're going to be there in like 2 seconds. Okay, so now that we know what liquidity is, first, okay, we're glitching. What is liquidity? It's resting orders. Why is that beneficial for us? Because the market needs orders to move. So obviously, us as traders, we would like to know where these orders are lying, because from there, again, what are we trying to do with trading? We're trying to accurately predict where price wants to go with a high probability on a daily basis. Okay. Once we understand that, we know that if we can spot resting orders in the market, then we are going to be able to accurately predict where price wants to go. Because if we know where liquidity lies and if we know where orders lies, then we are going to be able to take trades based off of those orders in the direction that those orders are going to push the market.
Like through the market, obviously. I know this probably ain't making no sense at first.
The center, the totem pole.
But as he explains, it'll start making more sense.
I don't even know the better explanation besides it's the goats of confluences, okay? Because this is where everything of our strategy begins. It begins with liquidity. It begins and it ends with liquidity, okay? So that's why it's important. Next, where does liquidity lie? Where are the orders? Where orders? Where the fuck are they? Let's think about this before I tell you guys. Let's think about this. What did we learn? When was that? Yesterday? Yes, yesterday. What did we learn yesterday? How to identify trends. How to identify highs and lows. So, if we as traders know that the market moves in higher highs and higher lows and lower highs and lower lows, what can we safely assume? Okay, we know that when we're forming an uptrend, people are probably going to be pressing buy. Okay, And when people are pressing buy, because the majority of people understand this market structure order, this is like very, very beginner stuff. Most people understand the market moves in higher highs and higher lows, lower highs and lower lows. Okay. With that understanding, when we're in an uptrend, most people, they notice and identify, hey, when we push above this high, I'm probably going to press buy. Okay, I'm not telling you guys to do that, but that's what the vast majority of people are thinking. Why are they thinking that? Because they're like, hey, we're in an uptrend, and once we push past this high, that means the uptrend is confirmed, and we are going to go up and make a higher high. So they're pretty much betting on the fact that once we push above this high, we're going to make a higher high, and that's how they're going to make their money, right? From pressing buy above this high and then trying to close somewhere up here. Or regardless, if it comes down a little bit, they're still probably in profit because it doesn't come back underneath this high. That's not what I want you guys to do, and I'll explain a little bit later why that's the case. But a lot of people are pressing buy above highs, okay? On top of that, when these people press buy, what are they doing? Well, there's two ways to take a trade, okay, in these markets, okay? It's by pressing buy and by pressing sell. The goal is to buy low and sell high and buy back lower. Okay, there's two different directions, right? You can make money in both ways through day trading. Okay, this isn't like investing where we're only trying to buy low and sell high. We have the
And that's what I like
opportunity
about
to
day
make money
trading, man.
both
Like,
ways in the market. Okay, we're switch
you can be
hitters. Okay,
on the
we can put
market
it in the
any
cooch
day, whether
or
it's
we can
going
put it
up,
in the
going
butt.
down, wherever the
Doesn't
case may
matter.
be. You can
Okay,
make money.
all fair game around here. Does not
Like
matter.
with
We're
stocks, like he
accepting
said,
of
with stocks,
both
you can
ways.
only
Okay, you can be a
make
switch
money by
hitter any day of
uptrends.
the week when you're a day trader. Outside of that, don't we won't talk about it. Okay. Okay. So when we're pressing buy above highs, what do we want to do? We want to protect our orders by using a stop loss. This is a very useful tool. It helps us so that we don't lose a significant amount of money. So if we understand in an uptrend, we are making higher highs and higher lows. And if most people are pressing buy after we push above highs in the market, what are they going to do, or where are they going to put their stop loss to protect their orders? They are going to put it underneath the low. Why are they going to put it underneath the low? Because if this is a true uptrend, then ideally we will not put in a lower low and we will actually put in a higher low. So this is our invalidation point, or these traders' invalidation point. They're going to be pressing buy when we push above a high, and then they are going to put their stop loss or their protection point underneath the low. Because ideally, if this is a true uptrend, we push above the high, we're going to make a higher high, putting their trade in profit. And in turn, if it's a true uptrend, it's going to put in a higher low, and that's why we have the stop loss underneath this low, because if it's a true uptrend, then this stop loss shouldn't get hit. And again, it's to protect us just in case market structure wants to shift. If market structure shifts out of this uptrend, then boom, this stop loss gets hit. You lose money on that trade. Now, you're probably saying, TJR, why are you telling me about all of this stuff? This is boring. This is lame. This is useless. Wrong. This is the most useful information that you guys will ever learn in day trading, because we are just doing that method right there, just going through that exercise. What did we do? We just identified two areas where orders are resting. Oh, yup. Get down there, buddy. Suck me off underneath the desk. Suck it, buddy. Yup. And what did we just identify? Where liquidity is, because liquidity is resting orders. So what is resting above highs? Buy orders. What is resting underneath lows? Sell orders. And that's for people that are looking for long positions, because again, they're pressing buy when highs get pushed above, and they're pressing sell, or their stop loss is underneath lows in the market. Okay, so there's going to be resting buy orders above highs, sell orders below lows. Sorry, I'm glitching. That was a big minus sign. You get the point. Now, if we go over to the right-hand side right here, when we're talking about downtrends, it's the same situation. If we're in a downtrend, okay, so this was putting in the cooch, okay, this is when you're putting it in the butt. Again, no hard feelings. I'm all for it, okay, especially when we're trading outside, do your thing, okay? When we're in a downtrend, this is the opposite direction. So same exact situation as the uptrend, but downtrend is just the opposite. So if we're in a downtrend, again, most traders are going to say, hey, we're making lower lows and lower highs. So when we push underneath this low, I'm going to press short, or I'm going to press sell. Why? Because we are in a downtrend and we're probably going to make a lower low. And then on top of that, the people that are pressing sell once we push
I'm
underneath
probably not
this
going to
low,
do a lot of
where are
talking
they
in this
putting their
video.
stop loss? They're putting their stop loss
I'm
above
more so
highs.
watching to learn
Okay,
myself,
so
so
notice
I'm just
we
trying to
have
digest all the
two
info.
sets of resting orders now. We have people who are going short on downtrends. They are pressing sell when we push underneath lows, and they are pressing buy or exiting their positions or putting their stop loss above highs in the market. So we have two sets of resting orders. There's people that are entering into positions when we push above highs, and then there's people who are exiting positions or getting stopped out when we push above highs. So there's two sets of resting buy orders above highs. Now that's a lot of orders. Not only do we have people pressing buy when we push above highs in the market because they think price is going to go higher, but we also have people that are forced to press buy, that are putting stop losses above highs in the market, that are going to get stopped out if these highs get pushed above. Why is that important? Because that is where liquidity lies. And what is liquidity? Resting orders. So again, there's people that are looking to press buy when these highs get pushed above, and then there's people that are exiting their trades and being forced to press buy because that's where their stop loss is above highs. Same thing with lows. When we push underneath lows, what is happening? People are entering into sell positions, okay? And then also, there are going to be people, when we push underneath lows, like let's say we push underneath these lows, there are people getting stopped out of their buy positions and being forced to enter into sells. So there's two sets of resting orders underneath lows. There's people who are entering into short positions or sell positions when we push underneath lows. And then the people that were previously in buy positions when we push underneath these lows, they are getting stopped out. So what did we just learn from that entire conversation? We learned where resting orders are. And you're probably saying, well, TJR, I'm on the spectrum and I don't know what you just said. Okay, Timmy, shut up. I'm going to tell you. Where do orders lie? Above highs and below lows in the market. Because there are people, when we push above this high, and let's just put on one trend so we can show this easier for you guys. Where orders? Where are they? They are above highs and below lows. And that is where liquidity lies. Okay? So let's say the market is trending up. Okay? This is our little uptrend. There are people that are going to be pressing buy when we push above these highs. And then there are also people, here, let me redraw this real quick. Okay, this is good. When we push above highs, there are people pressing buy. There are also people with sells resting underneath lows. Okay.
So what he means by sales resting underneath the lows is that when you have a buy order, you're clicking buy, right? Your stop loss will be down here below these lows. So that's where all the sell orders will be filled once people get stopped out. So for example, on this right here, if I click buy above here and there's a downtrend, right? The market reverse, the market reverses, whatever the case may be. These sell orders down here are getting filled because people are getting stopped out.
Why is this beneficial for us to know? So there are some people that see this and think, hey, we're in an uptrend. So when we push above this high, they are going to be pressing buy. There are also people, because again, people have different opinions on the market. People may think that the market's moving in a different way. Not everybody is going to be pressing buy when we push above these highs. Some people on this move down, they might be pressing sell. And if they're taking a short position on this move down because they think the market's going to continue lower on that move down, what do they have above this high? They have buy orders as their stop loss. So there's 2 times the amount of buy orders.
So you have the people clicking buy as it's going in the uptrend. They think it's going in the uptrend. That's one set of buy orders that we have. This is why there's two times of the buy orders. So you have people buying here. That's one set of the buy orders. You also have people that are going in for short gains in the market that are getting in the sell orders, but they have their stop loss up here, which represents the second um, set of orders.
There's people that are getting stopped out from their sell positions when we push above this high. And then there's also people that are pressing buy that are entering into long.
So boom. So right here, this is what we're talking about. This area here is where two sets of orders, damn, two sets of orders rest.
Positions. So there's people that are exiting their sell positions by pressing buy because, again, if we try and sell high and buy low, that's how we make money from the market. So these people see the market moving down, they press sell. Where are they going to put their stop loss? Above the high, because if that high gets pushed above, then their bias is wrong and the uptrend is continuing. And then there's also people who say, hey, when this uptrend continues, or if this uptrend continues and we push above this high, I'm going to press buy. So there's two sets of buy orders above highs. There's also two sets of sell orders underneath lows. There are people that, let me get rid of this, get rid of this.
Hopefully this is starting to make more sense.
Get rid of this. Oops. Get rid of this. Get rid of this. Get rid of this. There are two sets of sell orders underneath lows. So let's say, for example, right here, there are people that are pressing buy on this move up, okay? The people that are pressing buy on this move up, where are their stop losses? Their stop losses are underneath this low. Now, what happens when the market pushes underneath this low? The people that were in buy positions, they get stopped out. So they have to sell their position for a loss. So all the people pressing buy on this move up, when the market comes down and hits that area, they are getting stopped out of their trade and they are being forced to sell their positions back for a loss. There are also traders that when this low gets pushed underneath, that are entering into short positions because they think price is going to go lower. So there's two sets of resting orders underneath lows. Now again, you are probably asking, TJR, why? Why are you telling me all of this stuff? This is how the retail trader thinks. And what do we know about the vast majority of traders? 99% of traders fail. And I'm not trying to tell you guys this. I mean, we talked about this on day one. I'm not trying to tell you guys this to discourage you. I'm telling you guys this to use this to your advantage. We need to be thinking like the market movers. We need to be thinking like smart money. So if we understand that there are two sets of sell orders underneath lows and there are two sets of buy orders above highs, we don't want to be following the method of pressing buy when highs get pushed above or pressing sell when lows get pushed underneath. Because that is how retail traders are trading. That's how the vast majority of traders are trading. We want to be trading in the opposite direction. And this is how the market makers think. Going back to our topic for today's video. What is liquidity? Liquidity is resting orders. We just talked about where retail traders' resting orders are. Now, let's think about smart money and let's think about the market makers, the people who actually move the market. They need a significant amount of orders to be going in the opposite direction of them for their massive amounts of orders to be filled for them to be able to push the market in the direction that they want to go. You're probably saying, what does that even mean? Let me explain. Let's think back to our high school economics class. Okay, how does a stock exchange work? If I want to buy one
Yeah, I
share
had
of Apple
economics in high
stock,
school.
I need to find somebody that is willing to sell me a share of their Apple stock at the current price. Now, back in the day, it used to be done by calling up your broker saying, hey, I want to buy one share of Apple. They say, okay, I'm going to try and source this for you. I need to find somebody that's willing to sell it to you at this price. Nowadays, and then boom, they sell it to you. It takes a couple days and they say, boom, here's your paperwork. They ship it to you in the mail, and then awesome, you have your contract that says, I own one share of Apple at this price. Cool. The same thing applies, but in today's day and age, we have brokerages, we have exchanges that do this at mass scale online for us. Now, it's the same exact thing when these big smart money market movers are trying to place their trades and move the market. They need X amount of orders, like let's say freaking 1,000 orders to be going in the opposite direction for people. They need 1,000 people. Let's say they want to take a 1,000 contract trade. Sorry, we'll simplify this. Let's say they want to take a 1,000 contract trade. In order for them to be filled on those 1,000 contracts, there needs to be 1,000 contracts that are willing to either buy or sell, depending on what direction they want to move the market.
So basically, what he's saying is, in order for these major people to place 1,000 buy orders, there has to be 1,000 orders for them to buy. So there has to be people that are willing, 1,000 people willing to sell their orders for them to buy, to move the market in the direction they want to move it in.
The opposite direction as them. So if the market moves above highs in the market, to do what? To activate and get those two sets of resting buy orders to get activated, right? The people that were pressing sell.
So that's why it's
On the way
important
down, what do
for
they
us to
have? They
know
have their
where
stop
liquidity
losses above
lies,
here.
because that's where the
And
major
then
market
once price
movers
pushes
are
above
looking
this high, those people get stopped out of
to
their sell
to
positions.
manipulate the market.
And then also the people that think price is going to go higher, they enter into buy positions. So now there's a bunch of people that are willing to go long or press buy in the market. What does that give the market makers the opportunity to do? To fill their massive amounts of sell orders to cause the market to go down. Reverse psychology is how I like to think of liquidity. They are faking retail traders out to think that the market's going to go higher. They are getting people out of sell positions by pushing above the high, and they're getting people into buy positions, and then they're able to fill their massive amounts of sell orders because there's a massive amount of people that are willing to go buy here or being forced to buy their positions back for a loss. And then they are able to fill their sell
Which
orders
creates a
to push the
top.
market lower.
You'll probably hear it later on as we get more into
Same
it
thing in the opposite direction.
about mountain tops, but
If we have a
those
low,
are indicators basically where we have
what is sitting
a
underneath
high
lows?
come
A massive
down,
amount
another
of
high
sell
come
orders.
down, and the trend
Because there's
reverses.
people that are pressing buy because they think this move is going to go higher. Where are their stop losses? Underneath these lows. And then when the market comes down, trades underneath these lows, what happens? Those people that were in buy positions are forced to sell their positions back at a loss. And then there's the people that are entering into sell positions because they're saying, hey, a downtrend has started. What does that give the market makers the opportunity to do? Fill their massive amount of buy orders. Why? Because there's a massive amount of people that are entering into sells here. And then that gives them the opportunity to push the market higher. We do not want to think like retail traders. We want to think like smart money traders. We want to think like the market makers. That is why liquidity is so very important. And we're going to go onto the charts now and show you guys real-time examples of this happening. I'm not going to tell you guys how to take trades on this just yet. We're going to get into that later. So, with that being said, Let's show real-time examples of this happening. We have one right here. What do we have right here? A high in the market. All the people that were pressing sell on this move down, their stop loss is above these highs. Once these highs get pushed above right here, what happens? The people that were pressing sell get stopped out of their sell positions, and then all the people that think the market's going to move higher, what do they end up doing? They end up pressing buy because they say, hey, a new trend is going to start. What does that give the market makers the opportunity to do? Fill their massive amounts of sell orders to push price lower. This happens on every single time frame because this is how the market moves. The market needs orders to be filled. The market needs orders to be filled in order to push price in the direction that it wants to go. Let's show another example right here. Price comes down. Okay, so we just showed you guys an example to the upside. Now we'll show you guys an example to the downside. Price comes down underneath these lows. What do we know is resting underneath lows in the market? A bunch of sell orders. What does that give the market makers the opportunity to do? It gives them the opportunity to fill their massive amounts of buy orders. So when price comes down, what happens? All the people that were pressing buy throughout this, they are getting stopped out of their positions. Their stop losses are underneath these lows. And then all the people that think price is going to go lower, they are entering into sell positions right here. What does that give the market makers the opportunity to do? Fill their massive amounts of buy orders to push price higher. Hopefully you guys are starting to get this now. Let's show another example. We have a high right here. We have two sets of highs, and this is what we're going to get into for our advanced liquidity concepts. But we have a bunch of low resistance draws and liquidity stacked up relative equal highs. We'll get into this in tomorrow's video, but stacked up relative equal highs right here. What is that making the people do? When we push above this high, what are people doing? They're pressing buy. When we push above this high, what are people doing? They're pressing buy. Everybody that was pressing sell, where is their stop losses? Above this high. Everybody that was pressing sell, where is their stop losses? Above this high. So now we have 4 times the amount of orders. We have 4 times the amount of orders. Buy orders that are sitting above these highs in the market. What does that give the market makers the opportunity to do? Fill their sell orders above these highs. So the market makers push price up, manipulate these highs, enter their sell orders, and then what does the market do? It falls. This happens on every single time frame. I can show you guys examples of liquidity sweeps on the 5-minute time frame, on the 15-minute time frame, on the 1-hour time frame, on the weekly time frame, on the quarterly time frame. There are examples of liquidity sweeps everywhere. You remember the tariff, flash, crash, super spooky, oh my goodness. There's tariffs in the market. All that it was buying opportunity. We have a low, we have a low, we have a low. Sell positions, sell positions, sell positions. What does that give the market makers the opportunity to do? Fill their massive amounts of buy positions to make the rich get richer.
Somebody like me want a piece of that pie. I don't know about y'all, but I want to be a part of the rich that's getting richer.
That went around.
Let me tell you.
This is on the monthly time frame, folks. This is how the rich continue getting richer through market manipulation, through scaring the population with one agenda in mind, to make themselves richer. Oh no, super scary sickness, psych, liquidity sweep. All the people that were buying right here, entering sell positions. All the people that were buying right here, forced to sell their orders because their stop losses are underneath these high time frame lows. Oh no, the economy's going to collapse. All of you guys should sell everything. All of you guys should short everything. Psych. What does that give the market makers the opportunity to do? Fill their massive amount of buy orders and make the rich get richer. It happens on every single time frame. This is how the market moves. 15-minute time frame. What do? Push above a high, boom, market collapses. Let's go to the 5-minute. Let me try and find a good example for you here. Push above this
First
high,
time I
market
watched this,
collapses.
I don't know if I was just
Now,
tired or what, but it
before we end
wasn't
this
making as
video, I
much sense
don't want you
as
guys
it is
to
right
just
now.
think,
So if it's
okay,
not making
whenever we
sense,
push above
rewind
a
it, go
high,
back,
I'm going to
watch it
press
again,
sell, and whenever we push
um,
below a low,
and
I'm
hopefully
going
it
to
makes
press buy.
a little bit
That is
more
not
sense
what I
for
want you
y'all.
guys to
But
take away from this video, because we just demonstrated in yesterday's video that the market moves in trends. The market does move in higher highs and higher lows. So trends happen. But liquidity and liquidity getting swept and new trends being formed, that's how new trends are formed, okay? Through liquidity getting swept, okay? And by these orders getting filled. So if you guys think back to like kind of halfway through this video, there is something that I said and a word that I want you guys to keep in mind. When we push above a high and when we push below a low, it doesn't mean that the market makers are instantly going to reverse price just because there's buy and sell orders there, right? We can see here that, okay, we have a high, we push underneath a low here. Would that have been smart to press buy? No, we end up keep going lower. We push below this low. Would that have been a good spot to press buy? No, we keep going lower. We push underneath this low. Would that have been a good time to press buy? Eventually, yes. So what I want to end this video on is a very, very key component of liquidity. Liquidity lies above highs and below lows. All that liquidity does for the market makers is it gives the market makers the opportunity to change the trend. Okay, it doesn't mean that the trend is going to change every single time. It just gives the market makers the opportunity to change the trend above highs and below lows. Now, us understanding that above highs and below lows, there is an opportunity for us to change the trend. That is the first step of our strategy. Because if we
okay,
can
there we
focus on
go.
catching the bottoms of reversals up,
Strat
we are
one.
going to be able to make so much more money. And if we can focus on catching the tops of reversals down, we are going to make so much more money. Now again, pressing buy below lows and just pressing sell once we get above highs is not a good strategy. I could show you guys a million reasons why, but you guys are going to have to trust me on this, because again, like if we were to press sell when we pushed above this high, what would have happened? Okay, we lose a whole bunch of money. If we press sell when we push above this high, what would happen? We lose a bunch of money. If we press sell when we push above this high, what would happen? Well, we lose a bunch of money. If we press sell when we push above this high, what happens? We actually are able to make money. But notice how there was an opportunity for price to reverse here. Did it happen? No. There was an opportunity for price to reverse here. Did it happen? No. There was an opportunity for price to reverse here. Did it happen? Yes. So all that I want you guys to take away from today's video is just understanding orders lie and resting orders lie above highs and below lows in the market. We are going to get into later in this series of how to take advantage of the opportunity of understanding that orders are lying above highs and below lows in the market, and then how to identify other confluences to give us confirmation that orders are actually being filled on the market maker side and the trend is reversing. That's what we're going to get into later on in this series. So what I want from you guys, your homework for today, is to identify again, I don't want you guys to be trying to understand the reasoning of why did price reverse above this high and not above this high. We're going to get into that later in this series. What I want you guys to understand is understanding, okay, we know that price has the opportunity to reverse above highs and below lows. Your homework is to just find 5 examples of price pushing above a high and then reversing off of it, pushing underneath a low, and then reversing off of it. Very, very simple stuff. And then in tomorrow's video, we are going to get
All right, that about wraps it up, man. Y'all heard the man. Y'all got homework. Go look at these charts. Get familiar with these charts. Like I said in the last video, um, go and look at liquidity. Go find examples where these high buyers and these high sellers are these high market movers are manipulating the market. But yeah, man, that's about it for episode 2. I hope this is starting to make more sense for y'all as we get more into it. Um, but yeah, make sure y'all go hit that sub button, go hit that notification bell, so y'all can get notified when these videos drop, man. And without further ado, see y'all in the next one.